I hit record. Well, what's up, everyone? This is our stock market weekly update here on October 7th, 2019. You've got Travis here. You've got Nikki on as well. And it's going to be an interesting week in the markets. Like I said, there's, the big thing that the market's focused on right now is the U.S.-China trade talks, which start, I believe, either late Wednesday, early Thursday, depending on your time zone. So we saw some news come out here just after the bell. There was a tweet from a Chinese commerce minister about them not agreeing to, the changes to their intellectual property laws in China not even being on the table. So that's not a great way to start the trade talks week. But there had been news out previously in the market last week that the Chinese were looking to narrow the scope of the trade talks. So that may actually help get a trade deal done. It may not be exactly what the Trump administration is looking for. So we'll have to see how that pans out. But I think, perhaps if the agreement isn't as broad as all the things that they're trying to do, then maybe they can get something on the table and done, which would be probably helpful. But who knows, right? We've been talking about trade wars and trade talks for like 9 months now, so maybe 10 months. So we'll see what happens. I'm not holding my breath on anything. Obviously, these Chinese stocks that I continue to think are interesting, like Baidu and Ctrip and Tencent and JD that are on our watch lists. They've a lot of them have come in. Let's look at a 6-month chart here on Baidu. A lot of them in recent months have come back in after a little bit of a rally there mid-year, but yeah, a lot of them like Tencent here, at a near 6-month low. Even JD, which had really good quarterly results in its last quarter. Let's go to a daily chart here. Yeah, so you can see, JD's kind of been in a range-bound mode for the last couple of months. But yeah, these stocks could fly if we get a decent enough trade agreement in place. It's hard to put a probability on what that actually is today. We've just seen so much flip-flopping from both sides. So we'll just continue to monitor what happens and see if it provides us with any trading opportunities. This week, last week, I'll just recap real quick. Markets in the U.S. were a little bit mixed. S&P was down just slightly under 0.5%. NASDAQ was up about 0.5%. So kind of mixed there. And then Europe and Asia were down low single-digit percentages. Crude was down as well, and gold and silver were down. Oh, someone's ringing my doorbell. Anyway, we won't worry about that. But yeah, the gold and silver and crude commodities all down. Gold and silver, like we've talked about, have kind of been in correction mode in the last month or so. Like if we look here, look like those were seeing some real momentum and have kind of started to come in a little bit, but could just be a little bit of correction before this trade. Maybe it ends up starting to work again. I don't know. Silver looks like it's in more of a breakdown than gold, obviously, but it had a little bit bigger of a pop as well. So I think it's those are definitely worth keeping an eye on. And I noticed obviously again, crypto today was up with the market down a little bit. So there's, still looks like crypto's trading a little bit inversely with the market, which is interesting. So stocks and crypto together in a portfolio looking like a pretty interesting combo. But anyway, as far as this week, like I said, on the macro front, the biggest thing is U.S.-China trade talks. There's not a ton of macro data stuff. Like there's some Fed minutes that come out on Wednesday. Here in the U.S., we get some inflation data on Thursday, and then Michigan Consumer Sentiment Survey on Friday. I'd say the biggest piece there is probably Thursday's inflation rate data. So, everything's kind of going to be back-end loaded this week. Not a whole lot on the earnings report front either. Just a couple of companies reporting like Domino's Pizza, Levi's. Delta Airlines will be an interesting one for the airline sector on Thursday. And then Fastenal, which is one, company that sells into the industrial and manufacturing sectors on Friday. So a couple of those. And I believe it's not clear to me. I need to check, but Costco might also be reporting this week. It was reported last week that Costco was reporting. So I don't know what's going on with that one, but in any case, it's not one I'm really that focused on. But Yeah, in terms of news and earnings from stocks last week, Stitch Fix was one that I talked a bit about, and I actually wrote about it in my my investment newsletter. Hopefully, y'all are on that list. But this one had an interesting reaction off the earnings report. So it initially gapped down. It was trading about $20 a share, gapped down to almost $17 a share. It was down, some double-digit percentages off the earnings release. But I actually thought the earnings release was pretty good. This is one that Nikki and I have talked about for a while, but they actually saw accelerating revenue growth rates there for the quarter. And here, let's just pull up their presentation. I think it does a really good job of kind of describing everything. But yeah, if we look at the quarterly data on it, and they have a lot of growth levers that I've talked about, right? The men's business, the kids business, expanding into the international markets like the UK and things like that. So a growth company. Despite that, the stock price has been down a lot over the last couple of months, but revenue growth has been pretty robust over the last couple of years. Active client growth pretty good too. They've been sacrificing bottom line profitability here for growth, but that's typically okay if they're growing at a decent enough rate. And their long-term targets are interesting. I talked about this in my newsletter. So the newsletter is stockgeek.substack.com. You can go subscribe there if you want. But anyway, I actually had this video where I talked about Stitch Fix some. So I won't talk about it a lot here today, but long-term model is they want to get to like 13% EBITDA margins. And, if they do that, I think they can be generating a couple $100 million in free cash flow. And, that makes it pretty cheap on like 2 or 3 year out numbers today. However, I saw, and this is kind of what my post was about here on Substack, which I saw a filing from them last week about some grants of new stock to executives, and I just got really furious because when I dug into the details, it just made me really mad. But I'll talk about why here in a minute. But let me just cover, because I was trying to find it in here, but their numbers for the quarter. Why don't we just go ahead and pull up their earnings release here? 36% revenue growth, 18% active client growth. And like, if we pop over here to Koyfin, you can see, like if we look at the quarterly financials, you can see that 36% is actually an acceleration from like them. They were growing at like low and mid 20s percentage growth rates in previous few quarters. And so 36% revenue growth is quite good. But in any case, so I thought maybe the stock is interesting and starting to get really interesting. Net cash on the balance sheet, good management team, or so I thought. But then, I use this site BAM SEC to monitor filings when they come in. So I get alerted, for instance, today here was a filing from Cars.com, it's one of the companies I'm watching, but I got this filing from Stitch Fix, and I started reading through it, and basically they're granting this is a company that has about 105 million shares outstanding. And I read this and I'm like, okay, so they granted 5 million new shares to, they actually reserved 5 million new shares for future grants for employees and executives. And I said, okay, well, that's fine if those grants are for like the next 3 or 4 or 5 years. But then I read the details in here, and if you actually read through, they have a 2017 stock grant plan, and under that plan, they call this an evergreen provision, and basically it allows the board and the company to reserve 5% of total shares outstanding each year. So here's the line here. Basically, they can, starting in 2018 and ending in 2027, the board and the company can reserve a number of up to 5% of the total outstanding shares of the previous year. So basically, every year through 2027, they can allocate 5% of outstanding shares for new grants to executives, employees. 5% every single year. Now, 5% is a high number for like a 5 or 10 year period. Like typically, especially for a company that's just gone public. I mean, they were granting a ton of shares to insiders and employees before the IPO, right? Like they were already doing this and giving employees a bunch of equity. And yet now, as a public company, now they're allowing the company to dilute existing shareholders by 5% every year for the next 10 years. Now, it is possible that they may not do those full 5% grants every year, but for the last 2 years, they have granted, and I went back to the 10K for Stitch Fix to determine this, but for the last 2 years, they've done the full 5%. So in each of the last 2 years, since this plan has been in place, they've allowed the company to essentially create 5%, more shares. And so that dilutes existing shareholders. So if you're an investor in this company, what's happening is you're seeing your stake get diluted by 5%, which is not like an insignificant amount of dilution, right? 5% a year for like a decade, and you're going to end up, and that compounds. So you're going to end up with like less than 50% of your original stake in 10 years, just from dilution from employees getting granted all these damn shares. And like, it's like these shares are worth like $100 million today, right? And the stock's undervalued. So a grant of 5 million shares, this means like they're giving like, probably more than $100 million worth of value to employees every year. Like that's insane. So this has got to stop at some point. I mean, I don't know if it's going to stop, but I actually tweeted out at the CEO and one of the board members that I thought this was really egregious. You would never see something like this from a company, that's well managed, that wants to deliver true shareholder value to its existing public shareholders. Like you would never see this from a Warren Buffett company. You would never see this from a company with a significant owner operator who cares about driving per share stock returns. So it makes me mad. It's just bullshit to me. And so that's my rant. But anyway, I talk about this some in the post as well. You can see the tweets that I had. But anyway, that really turns me off from Stitch Fix. So maybe this stock continues to rally. It actually did rally off that gap down a little bit over the last couple of trading days. But I can't really get behind a company that allows that much dilution. And again, I think just so you all understand, typically I would say that 1% dilution per year is actually like kind of like the high end of what I would allow as an investor. I see a lot of companies that actually have, and we like to find companies that are net buying back shares. So not only offsetting dilution from share grants, but also actually reducing shares outstanding, right? And we have a number of companies on the watch list that have been doing that. What's a good example? I mean, we have quite a few, but like, let's just look at Lear, for instance, because Lear has been another one I want to talk about today that's been coming in. But if we look at the total shares outstanding, the total shares have been shrinking, and that's why it drives increases in earnings per share, even with net income staying flat. So if we let's look at the income statement and look at diluted shares outstanding, you can see, in the most recent quarter, 62 million diluted shares outstanding, and that's down from almost 70 million, like 2 years ago. So they're buying back shares and not issuing a bunch of shares to management and employees. And so we're getting a declining share count, which is really good. Yeah, Abercrombie also doing that. Some of the retailers we've looked at, like Nordstrom's and American Eagle, I believe are also buying back stock on a net basis. So again, I think it's okay to have stock grants to incentivize your executives. But if the executives already own a bunch of stock, like the CEO of Stitch Fix does, and you've already had a bunch of grants in the past, there's no need to keep granting massive amounts of stock. And in fact, you're hurting your ability for your stock price to go up if you're doing that. So I typically like to see companies with less than 1% per year share dilution. And in fact, again, I like to find companies that are actually net reducing shares, assuming the price of the company is cheap in the market. Buying back shares at a good price and reducing shares outstanding drives more shareholder value. So that's what I like to see. Yeah, actually, I think one cool way to see this too is like if we look at diluted shares outstanding for Lear, like on a 10-year basis. Look at this. Lear used to have over 100 million shares outstanding, and today they have they're probably by the end of the year going to have closer to 60 or 61 million shares outstanding. So that's fantastic. It means that existing shareholders, their percentage of the ownership of the company is actually increasing just while they're sitting there continuing to own their shares, because the company is buying back shares from other shareholders who are selling to the company at these prices. So That's the kind of thing I'd rather see. So anyway, that's Stitch Fix. I did think the earnings results were good, but I have a serious problem with the share grants. So even though I added Stitch Fix to the watch list, I'm leaving it on for now, but I'm probably going to end up removing it by the end of the year. But in any case, that's kind of my problem there. So it's fine. It's good to kill stock ideas when things aren't, when management teams aren't doing the right thing. Other than that, let's see. I talked about another company, Constellation, last week that was having earnings. So this one we've talked about because they own a large stake in Canopy Growth, which is a cannabis company that they have put like $5 billion of capital into. And cannabis sector's been hit really hard. Canopy Growth is down about 50% in the last 6 months. And Constellation actually got down on earnings too. The market, I guess, didn't really like their numbers. I thought the numbers looked fine. They're still growing at a revenue at a high single digits rate. They're launching a Corona seltzer, I guess, to compete with White Claw. But yeah, Modelo and Corona, their big beer brands, are still performing really well. I thought the numbers looked fine. They actually raised earnings guidance a little bit, but I guess relative to market expectations, it wasn't what the market wanted to see. And this stock had been trading at a well above market PE multiple. It is growing a little bit faster than the average company in the market, but valuation wasn't super cheap. So yeah, I mean, I think if this thing continues to shrink, I would start to get more interested. I think they probably put too much capital in Canopy. I said that before, but in any case, they didn't really even say very much about Canopy on their earnings call. So Constellation did mention that Canopy's expanding into new products like edibles and beverages, and they're prepping in a pretty big way for the U.S. launch. They had a deal with Acreage Holdings where they're buying a bunch of cultivation land and looking to be a big player in the U.S. market once it continues to kind of open up to legalization of cannabis. Too early to tell probably there on what's going to happen with Canopy. And I will say it is good to have a management team like you have with Constellation that like has run a successful business for a long time, and they can kind of help direct what's happening at Canopy, at least somewhat. So I think it's actually good to have like that kind of adult oversight over Canopy. So it probably raises the probability of Canopy's success relative to other players in the industry. At least, some of the weaker players. This is going to be an industry with multiple large winners eventually. Like I said, it's still probably pretty early to determine like who those winners are going to be, but everybody's jockeying for position and making acquisitions at a furious pace to try to position themselves. I have a lot more work to do in the cannabis sector to kind of better understand who I think is going to be the winners. But again, I do think Canopy potentially could be, one of the, it has a more probability of being in the top 5 or top 3 because it does have this capital backing as well as the management from Constellation helping them. So that's STZ and Canopy. We'll keep an eye on those. Some other earnings I saw, Lennar, the home builder. This is a stock that's performed well. Interest rates have gone down significantly in the U.S. obviously over the past 6 months, and so that's helped. Mortgage rates are down. I think average mortgage rates are down close to like 3.6% 30-year mortgage rates, which is like near its low, multi-year low again, and it's down about 100 basis points from this time I think last year. So that's really helping drive. Like Lennar was seeing 9% increase year over year in new orders, and revenue growing like low single digit percentage because prices are down a little bit on new home sales, but order volumes are up. So in any case, the lower interest rates obviously helping drive new home sales. Lennar's been buying back stock, et cetera, et cetera. So that's helped the stock a lot in the last few months. The home building sector as a whole, since like mid to late summer, has rallied. So we probably should have stuck with some of our earlier home builder plays that we had like the very beginning of the year, like Pulte and Beazer. But it was hard to know what was going to happen there given the recession risk and looked like things were rolling over in that sector earlier in the year, but it did turn out to be it kind of flipped short term. So anyway, other than that, yeah, Bed Bath & Beyond was one of the only other ones I think reporting last week. They had continued to have declines in comparable store sales. They had a high single-digit decline. They did talk about like they have an aggressive. See if we can. I was looking on Seeking Alpha earlier. I had the slides up from them. We'll just pull that up here. So yeah, it looks like they're aggressively, like some of their near-term initiatives to try to turn this company back around, because the stock's down like over 50% in the past few months. But the initiatives that they're really focused on are like they're closing a bunch more stores. They're trying to aggressively renegotiate store leases, and then reducing inventory and trying to get out of any like non-core businesses. They also talked about even potentially selling off they have some owned real estate. So they have about 4 million square feet of actually owned space. And so that's one of the other things they're doing. Yeah, I thought this was an interesting one at like when it was pricing in like total Armageddon bankruptcy at like $7 a share. It was like trading for, what was the market cap on that at $7 a share? I think it was like a couple hundred million yeah, it's not going to give us the number here. But anyway, let's look and see how many shares outstanding they have. Yeah, about 123 million shares. So yeah, it was about call it a just sub $1 billion market cap when it was trading back at like $7-8. And I'll just pull up the chart here. And that risk reward was starting to get interesting. You can see the stock has had look at a 1-year chart. It just was straight down for like 6 months. At these prices, I don't know. It's you have to believe that the turnaround is going to be really successful. I mean, this is a company that's still doing over 11 billion of annual sales, and they still expect to do about $2 in EPS this year. So it trades for 5 times this year's earnings. The question is, are those earnings going to continue to evaporate over time? And 5 times is actually an appropriate multiple to pay for this melting ice cube of a business, right? So I think at $7, when you were paying 3.5 times this year's earnings, your risk reward was a lot better than now that it's up another 50% from that bottom. But it could still go up from here. I just these really, really distressed retailers that I don't think have a really clear reason to exist, because Amazon and online is taking so much share from them. But those ones I'm less excited about. But in any case, it was interesting to see that the aggressive nature of what the management team is trying to do as far as lease negotiations and things there. So we'll watch that one. We'll keep an eye on that one too. Other stocks I'm watching, we've had quite a few of our stocks on our watch list come in the last couple of weeks. Like I mentioned, Lear and the Chinese stocks already. We've seen, like Baidu's back down here at one point last week or week before, I think dipped below 100 again briefly. And so, I continue to think that one's just excessively undervalued and just kind of waiting and watching there. Lear, the auto sector, released their quarterly sales for the third quarter last week. And, Fiat Chrysler is another one that's like really been beat up. Stock again trades for like 4 or 5 times this year's earnings, and it's just totally beaten up. The market's just totally leaving all the auto manufacturers or anything auto related, just sort of leaving it for dead because they think this recession is here and it's going to pound them into submission for the next couple of years. I don't know if that's true. I think Fiat Chrysler valuation is a little bit ridiculous, and I also think Lear is an interesting play on the industry because it doesn't depend as much on specific model refreshes or whose cars are taking market share. They're the number one seat and electronics manufacturer in the industry. They work with pretty much every major auto manufacturer. They have really good management and capital allocation, like I showed you with the share buybacks and things like that. Just a really well-run company. And on a long-term basis, I think it can be I think it can be a winner from these prices, but nonetheless, its stock has come down a lot in the last couple of weeks. You can see here from this chart. If we go to a daily, it's been pretty volatile this year, but since we got a little bit of a rally in August when we had that rotation out of tech growth names and back into value, but it's pretty much all the way back down since then. So that's one I'm keeping an eye on. I'm going to see if that one gets below $100 per share, I'm probably going to make that position bigger. So just keeping an eye on that one. It also has a dividend yield. Let's see, I think somewhere in the low single digit range right now. But we also get some yield from, it's only about 3% dividend yield or just under. But we also get, do get the, share buybacks, which really adds to our effective shareholder yield as well there. So that's, that's one thing to consider. Another one I'm watching, MAC, obviously Macerich. So the news I think that was driving this stock down in the last couple of days or last couple of weeks is Forever 21 is having a bankruptcy and they're going to be closing some stores. I'm not really concerned. The funny thing is, if we go back to some of the transcripts from the last earnings calls, again, another reason why I like using this site is because I can search through transcripts. There are other places where you can search through transcripts as well, but like Atom Finance, I think offers some transcript stuff for free. And sometimes like the investor relations sites, these companies will have transcripts as well. But like if I search Forever 21, there's a bunch of stuff that comes up, but you'll see that in their Q2 call, their most recent quarterly earnings call, they talk about Forever 21. There was an analyst that was asking them about, does your expectations of earnings this year already include Forever 21 and Barney's? Because everyone already knew that those companies were, meeting with restructuring advisors and looking at, downsizing their store portfolio. So basically, the CEO said, we've had multiple discussions with Forever 21, and we've got 30 store leases with them, and it's possible that a few will close, but it won't be significant to our overall rent and guidance for 2019. So again, and we've seen that in the past, they're releasing spreads, the spreads that Macerich is able to get in terms of stores that leave. They're able to they've actually had positive releasing spreads. They've actually been able to get higher rent per square foot from the new tenants than the old tenants that have left. So, Forever 21 stores closing might actually be beneficial for them in some ways. But in any case, I think it's a non-event for them. It seems to be a non-event. They do have some store leases, but some of those stores will probably stay open. And then the ones that close, I'm sure that they'll be able to release them over time. And, I'm not too concerned. But the stock, again, is reacting negatively. I guess the one thing to keep in mind with Macerich is that if we were to see a massive acceleration in leases getting renegotiated or basically retailers going bankrupt, then they might have a problem, because if half of their store base or something needed to close stores all at the same time, then the releasing would be a problem. Finding enough tenants to fill up the existing ones would be a concern if it all happened at once. But if these things happen, kind of over time as they have been, then it's manageable. And again, Macerich, most of their malls or retail properties are like Class A, which means they're seeing actual stability or even growth in foot traffic and things like that. So these are places where long-term retailers and entertainment providers and even, maybe even co-working spaces and things like that, these are places where they want to be located. And that's why we've seen, when I've gone through the Macerich investor presentations and things like that, we've seen positive releasing spreads. We've seen good metrics in terms of occupancy. We've seen, new tenants coming in like Amazon bookstores and Peloton and Bonobos, and new retailers and new restaurants, like they have a Nobu in their portfolio and things like that, right? So that again is why I'm not too concerned. And we have like all these insider transactions, where they've been buying, so that gives me some comfort also. But if I would love for this thing to trade down to a distress level at like $15 or $20 a share, and I could make it a huge position, but we'll see if that ever happens. Other than that, yeah, Abercrombie was another one that in the retail space, it's coming back in towards its lows. I wrote about it and talked about it back here on that big sell-off on its last earnings report, that I thought it was getting to like really, really absurdly cheap levels, and it's kind of getting back there again after a brief rally. So yeah, I'll watch that one. I'll probably look to maybe add to the position if it gets sub 14 again. Just have a small starter position there. And speaking of which, yeah, I had, the one position change I had this week was, I officially added a starter position in CenturyLink. And this is a company that's been on our watch list for about a month. I think I talked about it briefly before, but they provide, this is a company that it's interesting because this one has a lot of leverage. And I typically have been avoiding, at this point in the economic cycle, I've been avoiding companies with too much leverage. Like I've talked about why that is and why I have been looking for companies with relatively clean balance sheets. But this one's actually manageable. It's got a higher debt level, but it's trading so cheaply. They have a lot of fiber and telecom infrastructure that is, hard to replicate and that took a lot of capital to build out. And so this company, so you can see, market cap of 12.5 billion, enterprise value of almost 50 billion. So they have a lot of debt. They have, 30 some odd billion of net debt. And they've been paying that down. Their goal is to reduce their leverage levels over time. And that not only benefits equity, but it benefits the balance sheet. It benefits their ability to increase earnings per share for shareholders. And with lower interest rates now in the market, they're also able to refinance some of their existing debt at lower rates, which helps as well. So the stocks had a little bit of a correction after that pop that we got in September. And so I decided to pull the trigger. This thing pays like an almost 9% dividend yield. They used to pay at the rate that they were paying dividends a couple quarters ago, it was something like a 25 or 30% yield, but they decided to reduce the dividend temporarily so that they could pay down more debt, which I think was actually the right call. So that is another reason why the stock had sold off over the past year, because they had reduced the dividend. But in any case, it's still a pretty healthy dividend even now. And stock trades for like 5 times free cash flow. Like if you look at, cash flow statement, let's look on a trailing 12-month basis. This company produced in the last 12 months about $6.5 billion of cash flow from operations. And they do have CapEx spending that they have to continue to upgrade their fiber networks and spend on infrastructure and equipment to keep the network operating. But they spend about $3.5 billion in CapEx. On a normalized basis, they could probably spend $2.5-3 billion if they had to cut CapEx down to the bone. But in any case, yeah. So the cash flow from ops, let's call it $6.5 billion. Let's even say it's like, like $3.3 billion of current CapEx requirements. You're talking about free cash flow north of $3 billion still. Let's just even say free cash flow is more like $3 billion. And so you have a market cap of $12.5 billion. So you're talking about trading for just over 4 times free cash flow. And so that is, that's just a really, really cheap multiple. And this is, I think the fiber assets are really good long-term assets to own. They're trying to serve more and more, focusing on the business to business type of customers who need high broadband solutions. They do still have some legacy cable business. So they do support like a cable TV business for consumers. And that business has been in decline over time. And so that's why when you look at like their revenues have slowly gone down a little bit over the last few years. It's actually not visible here though. If we look at and that's probably because of the acquisition of Level 3 that they made. So the numbers are a little bit hard to gauge just looking on face value, the numbers. But if we looked at some of their earnings reports, you could see that on a like for like basis, the revenue in their cable business is actually down a little bit, while the revenue in their business, B2B business, the fiber business is actually up. So they've had a little bit of revenue decline over the past couple of years, excluding acquisitions, but it seems manageable, and they've been further diversifying out of the consumer business, and they know that that business long term is probably going to be dead in the water. So I've actually seen rumors that they're looking to sell that business as a whole. I just don't know what kind of multiple they'll be able to get for it. But in any case, cheap stock, I think, pays a great dividend yield, good price. They're paying down debt and doing the right things. So let's see if we can see the total debt balance here. You can see even in the last couple quarters, they've gone from like 35 billion of debt down to 33 billion. And they've talked about prioritizing debt pay down. So that's certainly what you want to see with a company levered like this. So that was CenturyLink. And then Nikki, do you have any updates on Domo? Any new info there?
No new info. I'm holding the trade still. I was watching it as the market was selling off. A lot of things were starting to come with it, so I was watching it pretty closely, and I liked how it reacted around support. So from the technical side, everything's still intact for me for now.
Cool. Yeah, it's getting a little bit of rally here the last couple trading days.
Now, fundamentally, obviously, there's the issue with them, running out of
cash in a couple years,
or cash too soon. So that's an issue. The growth is an issue, but the CEO purchasing $1 million worth of stock was quite an interesting event. So
at $17 a share.
Yeah.
And today we're below that even still. So
on the daily chart, it's still pretty intact actually. So I'm feeling okay with it for now. Nice little double bottom off of support. And we'll see what this market does, because I think that's going to influence the swing trade a lot.
Yeah.
And so if the market bounces back and we head back to all-time highs, then I'm expecting things to kind of go smoothly with this, especially with the volatility that it can trade.
Yeah.
So I don't know. We'll see what happens.
Yeah. Makes sense. Cool. One other stock that caught my attention that I'm starting to spend some time on, I just want to mention it to you all before I write about it probably later this week, but GoPro. So this has been a company that has had a lot of haters for a while, and you can see, I mean, it had a, I think it had a split or a reverse split at some point, but anyway, you can see like since its IPO, the stock's basically been in a downtrend ever since they IPO'd a few years back. It has about a $600 million market cap today. They announced last week that they were going to delay the, I think by about a month, the launch of their new GoPro camera, the Hero 8. And it'll still be here in time for Christmas selling season, but it's going to come a little bit later. It won't come as much in terms of Q3 sales, but it'll benefit Q4 sales. So the stock had gapped down like 15 or 20% on that news, and it's had a pretty rough go. In the last couple of months, but the one thing that's interesting, so they have they expect to generate about $100 million of EBITDA this year and about 40 cents in EPS. So it trades just sub 10 times earnings per share. So it's typically people see this as a hardware business, and it's they're dependent on these like product launches every 1 to 2 years. And so there's like a pop in revenues, but then it declines for a couple quarters, pop in revenues, and then it declines. But there's some interesting things that the company's doing in terms of trying to transition its business away from being totally dependent on hardware. So they've got a subscriptions business now, and I think people pay like $5 or $10 a month, and that gets them like it gets them a bunch of stuff related to like the ability to host videos in the cloud, I think it gets them discounts on like the hardware that GoPro sells and a bunch of other stuff. And essentially, like they have 250,000 subscribers now to the subscription business. And that business has been growing about 50% year over year. So that subscription business, especially if it continues to grow subscribers, is kind of an interesting driver. The CFO said on a recent earnings call that they can double their earnings per share if they get to 1 million subscribers, because the subscriptions business, unlike the hardware business, is very high margin. It's like 80 or 90% incremental margin. So for every new dollar in subscription revenue they get, like 80 or 90% of it falls to the bottom line in terms of earnings. So trading sub 10 times earnings today, and if they can actually even get to like, 500,000 subscribers in the subscriptions business, that can drive earnings growth. And you might be talking about an earnings multiple today of, closer to mid-single digits, which would be pretty cheap. And I think this might be a strategic asset for a couple of different potential acquirers. The other thing is like software, can they be a legit competitor to Adobe in editing? Because, we all know that Adobe stock's been a monster. Adobe, in the last like 5 years has been like straight freaking up. And it's, let's just look at the market cap of Adobe today. Now they have other products besides the video editing suite that they have. They have Photoshop and Lightroom and their whole suite. And they're a SaaS business, right? So they charge like monthly subscriptions, but one of their big products is the video, like Adobe Premiere Pro and Adobe Premiere Rush, and those types of products in their video editing suite. So yeah, this is Adobe is a $134 billion market cap. Now I'm not saying GoPro is going to challenge Adobe and be like beat them out in the video subscription segment, but GoPro has they're building up the software side of their business. They have a suite of editing tools. They bought a company called Quik a couple of years back that made a mobile app for like quickly being able to edit video footage on the fly from your phone. And so the question is like, can GoPro even capture like a small percentage of the video editing market? And can that be meaningful to, revenues and profit for a company that's less than $1 billion market cap versus Adobe, which is over $130 billion market cap, right? So the gap there is just so wide. So that's one of the things that kind of gets me interested in GoPro. Can they be a player in the video editing industry and really drive that subscription business, which would get a much, much higher valuation than the hardware business that they control today, right? So that's interesting. They actually merged a couple of the video editing apps they had into one recently. The one on iOS has 4.8 stars in terms of rating, which is pretty good. On Google Play, it's a bit worse. It's like more like 2.8, which is interesting, but they have some work to do there on the Android front. But yeah, they're tackling the market for video editing. They're tackling the market with their new Hero 8 camera. They're actually adding attachments that help people, video creators, like outside of the sports realm. They want to help like other people capture video, like all the YouTubers and people that, this is something that I've been spending some time on. If you guys know, I've got this YouTube channel where I'm trying to youtube.com/StockGeekTV. So subscribe if you don't already, but yeah, I'm starting to create content. And so I'm getting into the video editing and video capture world. And you need a lot of like things like the right lighting and the right sound capture. And so GoPro is now going after this market with the Hero 8. They've got all these new attachments. And so they've got like lighting attachments, and they've got, they've got like lots of built-in stuff too with like image stabilization. They've got attachments for like a shotgun audio mic and things like that they're doing to help improve the ability for creators to actually use GoPros to, be able to shoot quality video that they can upload to like YouTube and Facebook and Instagram. They want to simplify, obviously, the video editing, like I talked about before. And the $399 price point on the basic camera is pretty competitive. Like if they can actually capture some of this market, you know, a lot of people in this market spend $1,000 on a camera and then another $500 on a lens and then a couple $100 on lighting and all these other attachments. If they can, you know, hit that sub 500 or sub $1,000 price point, they're going to be able to capture some of the market potentially for, you know, for video creation. So that's interesting. But the other thing here is that, you know, could this also be a media and content play? They actually have a partnership with Adobe Stock, which allows a lot of GoPro captured footage to be sold in Adobe's, you know, video marketplace where people buy like stock images and stock videos. So that's something. But they have 40 million views per month on their YouTube channel. Like GoPro, YouTube, and also their Instagram channel and their Facebook page. You know, they have almost 8 million subscribers here on YouTube. They have, I think 16 plus million on Instagram and over 10 million on Facebook. So like these are also things that could potentially be monetized at some point. You know, it may be a little bit more difficult. It's not Disney, right? They don't control like the Marvel franchise, but perhaps there's some value in, you know, these large followings that they have in terms of some kind of a media or content play. You know, is someone willing to pay them $50 or $100 million a year to license, you know, some of GoPro's like amazing videos and footage? You know, I don't know, but that seems to me like a free call option. And there's clearly a lot of people who really enjoy seeing this content. I mean, I enjoy it myself. So, yeah, so that's some things that kind of get me interested in GoPro, with the stock being down and hated on this like mini delay and their like 1 month delay in selling the Hero 8 and things like that. Like that just doesn't seem like that big of a deal long term to me. So yeah, so I don't know. I'm starting to take a look at this. It's not the greatest business in the world. Certainly selling hardware is it's a tough business, especially in something as competitive like cameras. But at some point, the stock gets beat up to a level that doesn't reflect all this free optionality that you get. So yeah, so I'm starting to take some interest in that potentially. Yeah, if any of you have any thoughts on this one, I'd love to hear them, because I'm just kind of in the mode of gathering information. But yeah, I would love to hear your thoughts if any of you use the product or hate the product or anything like that. Other than that, yeah, that's really it, y'all. I think that's pretty much everything I wanted to cover today. So if you guys have any feedback or questions, let me know. Looks like Apollo had asked earlier about, he said he had missed an email about participating in a tender or a buyback of the Encana shares back in August. And yeah, so that I think I'd mentioned that in the channel briefly, but Encana, because the way that stock buybacks work in Canada, they had to like issue they were doing a kind of a different style of buyback where they actually, it's called a tender. And so they name a range of prices that they want to buy back shares, and they actually submit, shareholders can decide whether or not they elect to sell shares back to the company at those prices. And so if you do nothing, as probably most people did, then you don't end up selling any of your shares back to the company. But so you essentially would have to get that notification from your broker that Encana, like, which says, hey, Encana wants to buy back shares at X price. Do you want to sell? You have to actually do something with that and say, yes, I do want to sell, and I want to sell X amount of shares, and I'm willing to at X price. Then that would actually initiate a potential sale of your shares back to the company at those prices. So that's that's what's called a tender. Now, if you do nothing, then your shares should not get tendered back to the company in that case, at least in this case with Encana. So if you did nothing back in August, nothing happened. You didn't lose any shares. Nothing happened. Encana did buy back. They are buying back shares from shareholders who were selling them. So they will buy back shares from other shareholders. But if you missed the participation in the tender back in August, no big deal. I didn't participate in the tender, even though I knew about it, because I didn't want to sell my shares back to the company at those prices. I think the company's undervalued. So I'm holding my shares, and that's my plan. But yeah, tenders are kind of funky. I don't know if Encana announced the results of their tender. I think they probably did. Yeah, I think, yeah, so yeah, here they have some information. They had a press release on the tender results. Yeah, you can see like the price that they were tendering was like within a range of 415 to 475. But yeah, so you can see more tender stuff here under the filings. We can go look at more of that, but yeah, not a huge deal. OCY is asking about G-Sky. So yeah, G-Sky was one that we, I can't remember if I talked about on the market update, but OCY had brought it to my attention. This is a stock that is kind of a battleground stock. You can see that they IPO'd, I think back, what was it, 2 years ago or so, or maybe a year and a half ago. And another stock that's been crushed since IPO. And yeah, they had a big gap down recently as well. So they lost one of their banking partners. So G-Sky is an interesting business. I don't fully understand it yet. They provide credit for, they're one of these companies that helps consumers finance things on credit. So like sometimes you're buying like stuff on an online website and you see the ability to actually pay for that over time in installments or essentially on credit. Rather than paying it all up front. And this GreenSky is one of the companies that offers that capability. And they partner with some different banking institutions to help enable that functionality. And they lost one of their big banking partners recently, and that was the reason for the gap down. The financial performance has also not been great because there's they actually do share some of the credit risk on these contracts with their banking partners. And so when credit losses rise, when more people are defaulting on their payments for the stuff that they bought, GreenSky shares in some of those losses, and those losses have been increasing over the past couple of quarters. And that is a real concern. And so, especially if we're, going into more of a tricky economic environment, that could potentially accelerate, because we're actually at all-time, or not all-time, but 50-year lows in terms of unemployment in the U.S. And so even though we kind of have this manufacturing recession, most people still have jobs. And if that changes, if the unemployment starts to rise, you'll probably see these delinquencies and defaults on these credit products start to rise a lot. And so I think people are worried about potential exposure there with GreenSky. And I would be similarly worried, given the fact that they're already seeing a rise in delinquencies here. Now, with the stock price beaten up, the question is it already priced in? And I believe that there were some insider purchases here, right? OCY. Yeah. So, well, actually, no, this was back in 2018 when there were some insider purchases. But there was some other news. I think that there were rumors that the company was being shopped to private equity firms. And so there were some rumors that the company may look to sell assets or go private because they believe that their stock was undervalued. And so that was one thing that I think was getting some people interested in the stock. Now, I saw some interesting analysis on Twitter that, let's see if we can find it. I saw a couple of different things. I saw one thing that was bearish and one thing that was bullish. Twitter's sometimes kind of an interesting place to find interesting information on stocks. Like most of it's crap. Like all this stuff is just total crap, day trader crap, automated bot crap. But there was a guy pointing out that he thought he had some interesting insights on why he thought that they were about to potentially lose their second big banking partner I think in November. Actually, let's see. I think that banking partner Yeah. So here we go. He is essentially laying out the case that um, that Green Sky has a banking partner, Fifth Third Bank, that is no longer listing Green Sky in their fintech partners list in their investor presentations. They had extended. He mentions later that they had an amendment to the contract that was only like a 90-day or maybe it was a couple of months extension instead of like multi-year extension. So y'all can, I'll link this up, this Twitter thread, but I thought it was an interesting one. Here, I'm going to link it up in the chat here if y'all want to read through it. Oh yeah, and Michael Burry bought some shares in this, I guess. So Michael Burry of the subprime bet. What was the movie that kind of detailed Michael Burry's famous bet on subprime? God, I'm blanking. I literally saw that movie on a plane the other day for the third time. Let's see, Michael Burry. Let's see who owns most of the stock right now. Yeah. He's not like a huge holder. Let's actually pull up Michael Burry's holdings. Scion is his firm. Scion Asset Management. So let's see. Yeah, he owns some G-Sky. So Michael Burry owns a small amount of G-Sky. Looks like 600,000 shares, about $7 million worth of G-Sky, which is a mid-single digit percentage of his holdings that he's filed with the SEC. The Big Short. Thanks, guys. That's the name of the movie. So anyway, Burry filed on as owning some Green Sky. So that got some people interested as well. But with the stuff that I was reading from this guy detailing that he thinks they're about to lose another banking partner here in the next month or two, I think that's a pretty big concern. Plus, with the credit losses accelerating, I definitely, I don't know. It's a tough one. I think I'd have to spend a lot more time getting comfortable with some of the issues to get comfortable around buying shares in this one. But yeah, I mean, stock's down a lot. Burry owns some. Burry's track record hasn't been great lately, though. So he's obviously a very smart guy, but he's had some real stinkers. He buys a lot of cigar butt businesses. And I sometimes do the same thing. Like I look for a lot of like beaten up stuff, but I also look for stuff that's beaten up that has some compelling reasons to own it. Typically, like this Core Point Lodging, I think is one of his biggest positions, and it's been a stinker over the past year. So just remember, like Burry, like everyone else, even though he's a great investor, is not going to bat 100% on his investments. So be careful about blindly following a famous investor into a trade. I always like to see that as like one of a multitude of signals. Yeah. So yeah, MEIP. Apollo's asking about MEIP. I was just going to pull up Burry's stuff here again real quick because I was going to order by his largest positions. Oh, he also owns TLRD, Tailored Brands, which has been a stinker. Oh, I guess he blew out of CPLG. He's out of CPLG now. I guess he cut his losses on that one. Interesting. Yeah, I hadn't looked at his portfolio in a while. So Burry's largest position today is Tailored Brands, which I've mentioned briefly in the past. It's a retailer that owns Men's Warehouse and Joseph A. Bank. It's got a lot of leverage on the balance sheet, but this stock has been absolutely decimated. It's part of the retail apocalypse. It really just trades for option value now. It's got like a $300 million market cap, but a multi-billion-dollar enterprise value. Let's just look real quick. And it's Michael Burry's largest position. Oh, $200 million market cap today, but a $2.3 billion enterprise value. So about $2 billion in net debt, $2.1 billion in net debt on the balance sheet. in declining revenues and earnings. That's really the concern here, is if they can't turn around or stabilize revenues and operating income, this company is going to be bankrupt pretty quick because of all the debt. So that is the concern with this one. I mean, yeah, I would have to look a little deeper too into the debt covenants and stuff. But yeah, Men's Warehouse, Joseph A. Bank, a lot of those stores are in malls that are declining, like the Class B, Class C malls. Like there's a lot of Men's Warehouses in those kinds of malls. Now they do have some good locations too, and they've got like the clothing. They've got a lot of strip mall units as well, but like they have problems with like Joseph A. Bank, which is like deeply discounted men's clothing, and it's like millennials don't really like older generations were like the prime customers, and so they have kind of a demographic problem too. Let's look at their most recent results. You can see here's their comp sales change by brand. So they're down about 3-4% year over year in Men's Warehouse, Joseph A. Bank, K&G, pretty much every one of their retail concepts. So that's not like terrible, but it's not good with all that debt on the balance sheet. But yeah, the market cap as a percentage of enterprise value has gotten really, really low. So, all right. So going back to the question on MEIP, yeah, I'm surprised. So I haven't had a chance to fully review it yet, but they had an update with some of their data on, and the data was good on some of their drug trials. Let's see if we can find it. Yeah, there was a transcript here. They had an investor in an analyst event that was an update on one or two of their drug trials. And initially, I think the stock had popped after hours like 20%, but then it's like hasn't gone anywhere since. Yeah, you can see they have this big candle. Like it looked like it was poised for a big breakout, and then ended actually, I think, in maybe the day down. And yeah, hasn't really been doing much. I met with the CEO back in September. I felt like he got it, and he's like he understands the challenges as far as like fundraising and what they need to do. He's really positive on the potential option value of their pharma portfolio. Yeah, but I can't really make the position bigger, even though I think it's interesting, really, really interesting at these levels. It's got really high upside. I'm scared to make the position bigger because I still think they have this problem with funding the business for the next couple of years. Like until I see something like a new partnership that helps them raise capital that extends their runway or something, then I'm still going to be worried about them having to dilute shareholders down at these really, really low prices. And so that's the concern, is like a death spiral where they're going to have to raise more money at lower and lower prices, which means just like massive dilution. So there's a potential scenario there, even though they've got all this potential with their drug pipeline. So it's just a really tough one. I'd like to be able to make it bigger. I just can't. Not right now. Not until I see something. Even though the CEO has told us back in September that he wants to try to do a partnership deal rather than raise capital here at these prices in the stock. So he wants to try to get capital in a good partnership deal rather than having to raise it in some really massive dilutive equity financing. But whether or not he's actually going to be able to pull it off is another matter. Now, again, if they can fund themselves for another year or two, or they actually have funding, I think, for about 18 to 24 months currently, but they need funding beyond that to take their drugs to market. And if they can get a couple of years of funding runway without massively diluting shareholders, this can be potentially a $10 or $20 or $30 stock based on the continuation of their drug pipeline moving further and further into commercialization. So a lot of potential upside still, but I'm still concerned about the financing aspect. And so I don't want to make it a big position. That's frustrating. What else? Oh, OCY was asking about news on CTT. Didn't see any company specific news per se, but Portugal did have their elections in which they this was, I think, just over the last couple of days, where the party that was in control maintained their control. So there's some stability there on the political front. I don't know really how that's going to affect their negotiations with the government. I don't know enough about the inner workings of what's going on with those negotiations, but I have pretty good faith in the current CEO Joao to actually get those negotiations done at a level that helps the company going forward. Because what they really need to get out of those negotiations is the ability to price some of their individual services in the postal business. They need to be able to get more leeway to increase pricing, and that's one of the things that they're focused on getting. So, yeah, it's kind of wait and see mode there. I don't think there's been any major company specific news, but we should get a bunch of company specific news from CTT in probably the next month or two, with the negotiations with the government, and and then I think one or two other things potentially as well. But like they were hinting at some possible real estate transactions and things like that. Just double check the investor relations site. Make sure nothing came out in the last day or two that I didn't see, which it is possible. Let's see. Yeah, this one's actually, I forget exactly what where their news is. I guess investor relations, press releases. Here we go. Yeah. There hasn't been, I don't think there's been any news since September. But yeah, you can see that insiders were still buying stock back in September. This is one of the board members. This is actually the hedge fund manager that I know who's on the board. His fund was buying stock still back in September. So nothing new there. That's really it. Well, how about we end it there, y'all? It's been about an hour. We'll give everyone a rest. But it was a fun one. I think U.S.-China trade talks Thursday. Maybe we get some fireworks, but we'll stay tuned. And if you have any questions, as always, if you have any suggestions, questions, anything else, hit me up in the channel. I'll see y'all later. Take care, guys. Have a good one.